So just for fun, as they say. So we're going to dive in. As always, I encourage you to take some notes. I will talk a little bit about one of these properties that we talked about yesterday for those of you who were not around yesterday. We can do that. But anyway, this is the Ann Arbor Real Estate Investors Club Fundamental Fridays series. Today's session is what I call Deal Analysis 101, which is a 10,000 foot flyover of deal analysis. So I'll give you kind of, it's going to be a little bit of a fire hose today, um, but hopefully not too overwhelming. I will give you a cheat sheet on the back end with a lot of the formulas I talked about and the numbers that go into analysis, and we'll go from there. And like always, if you have questions, I appreciate maybe putting them in the chat, and I'll address them at the end because there's a chance I might address it, a couple slides after you have the question. But we'll go from there. So today's objectives. I break it down into four basic formulas based on exit strategy, and then I talk about doing. I call it back of envelope analysis, which is where you have the knowledge of how to analyze deals that you don't have to run to your phone or your computer or some sophisticated thing to do an analysis, that you get comfortable enough with what numbers you kind of need in order to do kind of an analysis on the fly, as you see something in the field or as something is presented to you as you're out and about doing your business. And we'll dive in a little bit to this duplex that it's not listed, but it's potential. It's going to sell sooner or later, one way or another. But it's a good case. But it's a good case study, and I didn't bring the details of it, so I'll have to go from memory. So the most common question I get for people just starting out, and I say, well, what are you looking for? Well, I'm looking for a good deal. Well, what's a good deal? Well, yeah, Brian, just send me a good deal. Well, a good deal for one person is not necessarily a good deal for another person. So this is where I get to kind of repeat one of my mantras for that I kind of try and ingrain in everyone to, stay in your own lane, have your own, long-term plan and short-term plan. And the short-term plan is your buy box for your next deal. And that it's your next door or your next brick in your real estate investment career. So I need you to circle back in your own mind in the objective being that you determine what's a good deal for you. I don't determine what's a good deal for you, or somebody else doesn't determine it. You're the CEO and you determine what's a good deal. And the key concept that it took me a while to learn when I was just starting out, because again, you don't know what you don't know. And you figure, oh, analyzing deals, well, there's just one way to analyze a deal. Well, the epiphany is that you analyze a deal based upon your exit strategy. And when I talk about four different ways to analyze the deal for today's purposes, it's based on four separate exit strategies. So there's one property, but there's really four different ways to potentially analyze it. And I'll walk you through that. So what you have to have going into your analysis is, to make the analysis valuable for your time and your practice. And if you're going to analyze a deal a day, like we advocate. Um, you're going to want to know what your long-term plan is, your short-term plan is, and your exit strategy. So, going into an analysis and going into buying a property, it's one of, Stephen Covey's 7 habits of highly successful people is you begin with the end in mind. What are you ultimately going to do with this property? Are you going to wholesale it? Are you going to flip it? Are you going to fix it up and get a tenant in there and hold it forever and pass it on to pass it on as part of your legacy? That's your exit strategy. You got to figure that out going in. All right. So here are some terms. Um, Again, these are on the cheat sheets as well, but these are the things that need to be top of mind all the time. These are common denominators pretty much for every deal and every exit strategy. So this is kind of a checklist that you should go through, either on paper until you are able to commit it to memory and to your DNA. Um, of numbers that you need or need to have a level of confidence in your estimating skills, which comes from practice, um, for every deal. So a lot of investors are, typically new investors or investors in our group are trying to get properties that are in some state of distress or disrepair in order to add value to it to build equity relatively quickly. We can talk about turnkey stuff a little bit, but that's kind of, we don't need to do that. So the first number you're going to want to be able to analyze, especially if your exit strategy is short term, is what is the after repair value of the property. So if you're engaging one of the first three strategies, which is wholesaling, flipping, or the BRRRR strategy, which is buying a distressed property, rehabbing it, and then renting it out and keeping it as a rental, you're going to want to be able to assess the ARV, because the ARV, well, it's important to you, but B or 1A is the after repair value is very important to your lending partner, which again, it's kind of a lead into next week's session. So you're going to have to find a way and practice. And this is one of these things that you're constantly learning, because the overall market is constantly changing, but the local markets and the hyper local markets of where your properties are, those are always changing. So the ARV is pretty much of a moving target, that you need to learn that and appreciate that and value that and be able to do your research where you have a good handle on it. And how I try and approach it, as a realtor, as an investor on behalf of my investor clients, is I want to know the local market and trends and predictions and do a crystal ball as well as I can, so I can educate not only the investors but educate the investors lenders. And that's all part of the analysis that I use. And my approach to it is, I want to approach an analysis the way a lender is going to look at it and the way an appraiser is going to look at it. Okay, most importantly. So I want to try and estimate value and analyze deals based on what those guys do, the standards that they use, and what numbers they look at. Okay, because they can't know everything about every piece of property in every hyper local market. So it's incumbent upon me and you as the investor to know the market and to know these values and have confidence in them. And then when you exude that confidence in your communications to your lender, then your lender's going to say, "This boy, this guy knows what he's talking about. He's done his homework." You know, they don't have to reinvent the wheel, and that's all about building relationships with the lenders, which again is next week. But you get the idea. So the idea is trying to put yourself in the shoes of a lender and or an appraiser as best you can, and try and look at these properties through that lens or through those glasses. All right. Property taxes, I'll give you a website that will help you with that. Insurance, you can ballpark, but I encourage you strongly to start to build a relationship with an insurance agent if you're not already in the market and don't already have one. Um, Coincidentally, because I set this up and I kind of try and plan ahead. Um, at our next Rainmaker session, I forgot to tease it out yesterday, but at our next Rainmaker session, I'm having we have an in-house insurance guy at Real Estate One whose office is right literally across the little hallway from mine. Um, and he is very sharp and very knowledgeable. He's going to come to Rainmakers next session, and he'll give you kind of a little bit of the lay of the land of insurance, uh, insurance rates, what impacts what, and now obviously a lot of the big talk is about the hurricanes and the fires and how does that impact insurance rates across the country. So it's all fascinating stuff. And his name is Hunter, and he's a good guy to put on to add to your team, um, because he has access to multiple. He doesn't just sell one. He's not one company. He's not like with State Farm or Prudential or whoever. He represents multiple companies, so he has the opportunity to get the best coverage at the best price. And that's number one. Number two, he's a very knowledgeable guy. Maintenance, you'll also be able to ballpark, and that's something that you will make your own executive decision about whether you're going to go and shovel the snow and cut the grass yourself, or whether you're going to pay people to do that. Um, Utilities also, you can get the historical data from a property on costs of utilities, um, cost of money, talk about next week. Transaction costs, those are the soft costs that are involved in the transaction. Obviously, transaction costs, there's expenses related when you buy the property, there's expenses out there when you sell the property. They've got you coming and going, and that's just a fact of life. um, as is Uncle Sam, where this is where my CPA tells me to tell my class every time I have one of these classes to get with your CPA, partner with your CPA, tell them what you're doing, share your long-term plan, your short-term plan, your exit strategies with these properties so you can be a little bit better prepared when tax season rolls around. And that's another mistake that a lot of investors make, is they don't do that, and bad things happen because there's only two things for sure in life, and that's death and taxes. So write these down, get these ingrained. I have them on the cheat sheet, but these are a checklist that you're going to go through. Any property you look at, before you look at them, you're going to have to kind of have a working knowledge of these numbers. And it will vary property to property, and it will vary exit strategy to exit strategy, but these are really the fundamentals that apply to almost every transaction and every analysis. All right. So, Brian, that's great. Thank you for sharing all that, but where do I get these numbers? All right. Um, you get these numbers. The ARV, I'm going to talk about in the next slide. It deserves its own slide. But, since I go down in sequence, the ARV is kind of the top number you're really shooting at. And then, once you get that, if that reaches a certain threshold, then you start doing your analysis for the rest of these numbers. But if you do your as you go through the process of analyzing a property, and you analyze the ARV and you say, well, I can't make sense of this deal based on the ARV I'm coming up with. Therefore, you don't need to waste time doing these other numbers, if you get what I mean. But here's a thing that I'll talk about in the next slide a little bit. But not every deal is a good deal. And that's another thing that, novice investors need to learn. Even experienced investors get caught up with it and try and put, you know, a square peg in a round hole. The numbers don't lie. That's one of the mantras I love. I love saying it, but it's a reality that I have to say at virtually every session, and is that the numbers don't lie. So as a real estate investor, don't fall in love with a property, okay, and don't try and make the numbers work where the numbers don't work. You need to get to a point where you trust your analysis, and this happens all the time. And new investors come, they do their analysis, they come back to me, they go, Brian, I'm running the numbers. The numbers don't make sense. I'd be running in the red. They don't make sense. And you think, because you don't know any better, you think that you've done the analysis the wrong way. And 9 times out of 10, I'll say, no, you got it. You analyzed it the right way. This deal doesn't make sense. It doesn't make sense at this number. And that's kind of the little exercise I was doing yesterday, is that there are properties on the market, and these are examples of them, but there are lots of them that are on the market and they just simply don't make sense at the numbers that are out there. So that's where the negotiation comes in, the motivation of the seller comes in, the motivation of the buyer comes in, and all of those factors come into the transaction and work it out a different way. But when you look at it in black and white, you know, you as a CEO, you say one thing, you say, wow, this property really fits my wheelhouse. This would really be a great asset to my portfolio, but not at these numbers. Okay, I'm going to keep an eye on it. I'm going to establish establish some credibility with the seller, and try. It's not like you're convincing. I mean, you are in a way trying to convince the seller, but you're trying to get the seller to see it from a buyer's point of view. And once they do that, depending on how motivated they are to sell, another example of something with one of the people in the group yesterday. Yeah, I talked to the listing. I talked to buyer. Buyer said, Brian, I like this property, not at this number. It's been on the market a long time. Can you find out what's going on? I find out what's going on with the story. Yeah, Brian, we've had some offers on it, but my seller is pretty dug in on his price, and he's not that motivated to sell. And then it's like, well, okay, it's been on the market for 140 days. You can kind of count on it being on the market for another 140 days, because the numbers the numbers don't lie. So that seller is going to have to wake up one morning and say, yeah, I guess the numbers don't lie. So, because the seller is still convinced that the numbers lie and that there's a buyer out there. And there might be someone willing to overpay. But that's what I'm telling you, to trust yourself, and do that. All right. property taxes. Here's the website. It's michigan.gov, property tax estimator. You can um, open up your computer. This is how I do it. I don't save the this whole URL, but you type in Michigan property tax estimator, and it will take me to the state of Michigan treasurer's site, where it's a property tax estimator, and it's just a calculator um, that will give you the future tax based on if the property sells today. What's that future tax going to be if you're living in the property versus if you're an investor? And this is where the sticker shock comes in. And I told it yesterday. That's these three properties that are on the market right now. That's the sticker shock because uh, you know investors have done the ARV, and you look at the property taxes, and that it has leases in place at a certain price. And when you plug in the new property tax number, because this owner has owned it for a long, long time, his taxes are small. They're only allowed to be raised, at the rate of inflation. So they will be, it's called uncapped once the property is sold and a new buyer buys it. And that new property tax bill kills the potential of the deal for the average investor, unless that investor has some other type of strategy with that property. All right. Insurance, I talked about hunters joining us next week. Um, Maintenance, I've got handymen that I can refer you to if it's, something more than just the routine of shoveling the snow and cutting the grass. But I mean, if you have a single family home and you have to hire somebody to cut the grass and shovel the snow, I mean, figure ballpark $40 a week, you know, times 50 weeks, give or take. That's maybe 2 grand for maintenance. That's assuming you're holding the property, but you will have maintenance costs if you're flipping the property. You can't just not shovel the snow or not cut the grass. You've got to do that while you're doing the flip. Um, Cost of money, lenders, we'll talk about that next week. Transaction costs are your title company. So Leon represents a title company. I use a couple title companies. Not every, but most title companies have got a website that have a calculator on it where, you can plug in what you're paying for the property with the location of the property, this and that, and they will give you an estimate of what their closing costs are. I ballpark it typically as 1.5% of the price. And again, it varies on what you pay if you're the buyer or you're the seller, but you can get a lot of great information from title company websites. So you need to learn that piece of it. And then Uncle Sam is your CPA. And I kind of recommend not necessarily going to TurboTax or any of those, to get yourself a CPA who works with investors, and again not only just works with investors, but works with investors, in a similar scenario as you're in, as far as what your long-term plan is, your short-term plan is, your other income. Those type of things all come into play. That is way over my head and way over my ability to explain it, intelligently, as well. But you're going to have to get a CPA on your team. So this is where the team building element of your real estate business comes in. All right. Partner with your realtor on the ARV to be a second set of eyes. Partner with your insurance person, your maintenance people, your lender, title company, and accountant. So those are all people you got to add to your team, and you got to have them lined up ready to go when you're ready to pull the trigger on these deals. All right. ARV, here comes the fire hose a little bit, but this is on the cheat sheet. But um, these bullet points um, are the bullet points that, again, lenders use, and more importantly, appraisers use. Okay, because sometimes you'll have a lender, and the lender will want you to hire an appraiser. So the appraiser is kind of like the gospel, because the appraiser is a neutral party, has no vested interest in the property one way or another. They get their flat fee, no matter what the number they come up with is. So it really doesn't matter to them what the final number comes out to be. And they should be that way. And that's their job, and that's their obligation, is to be like a referee. Whereas obviously the lender has a vested interest, the investor has a vested interest, the realtor, if there's a realtor involved, has a vested interest, and the buyer has a vested interest. So everyone has, ulterior motives in the deal except for the appraiser. So anyway, you want to find fixed up and sold properties most similar to the subject property. Now, obviously, if you're analyzing a property in a subdivision that was built at the same time by the same builder with similar houses, it is quite, not completely easier, but it's quite a bit easier than estimating values on properties on the old west side of Ann Arbor, or in other areas where there were different builders, different styles, different ages, different conditions, different upgrades, all of those things. So you want to still try and get some common denominators that an appraiser can hang his or her hat on. All right. So the most similar points to start off with is like location, square footage, and the time of the sale. So those are the top three kind of common denominators. And I do some freelance work for a couple. They're called asset management companies, where they hire me to do reports, not on ARVs, but they call them broker price opinions, which is, Brian, we want to pay you for your opinion on the value of this property today. And this is what I have to spit back to them as far as reports are concerned, using these common denominators. And that the asset managers work for lenders, and so hence this is what the lenders look for when to minimize their risk in lending out the money on the property. So you want to find properties that are the most similar. But so the net that I cast out when I do these is I look for properties within a mile radius of the subject property. But here's the caveat: you have to, know what's going on within that 1 mile, because just for simplistic purposes, within that 1 mile, there could be a railroad train that cuts right through it. And we all know that in some locations, the properties on one side of the railroad tracks are vastly different from the other side of the railroad tracks, even though they're within a mile of each other. That's especially true as you get closer to Metro Detroit. But it happens a lot, here in Ann Arbor. I use the example of my house. My house is in a pretty upscale subdivision, but within a mile there are some properties. They're not close in square footage to mine, but they're there are properties that are within a mile that don't compare to mine, but some, online algorithms like Zillow or Redfin and those, they just take in what's sold within a mile, and then they, recompute it by square foot, and then they value my property that way, which is the wrong way to do it, but that's what they do. And, misinformation out there, makes it more difficult for everyone. But anyway, so you have to be sensitive of that even though it's within a mile, it's not necessarily a good comparable property. You have to weigh all these things. And what you're trying to get at, and what I try and get at, is get it down to the three best comparable sales that you can find, and use those to hang your hat on. You don't need five of them. You don't need 10. You don't need 20 comps. You need three good ones. And if you don't have three, then you have to take into consideration, number 4, 5, and 6. Within a mile, sold ideally within the last 6 months. If it hasn't been the last 6 months, and I'm going to go way over today on my time, I apologize. Within the last 6 months, within 10% of the square footage, either way, 10% more square footage than the subject property, 10% less of the square footage. That's your kind of search window. As close in age as you can get to the subject property. All right. And then you want to tick down to, similar styles. If you're analyzing a ranch property, you want to analyze ranch properties. But if there are no ranch comps, if there are no sales within the last amount of time, within a mile, etc., then you can move to a different style. Um, you might want to research further out that, okay, well, there's a good comp of a ranch, but it's 2 miles away. It's not 1 mile away. Or it has this additional square footage, but it's close in age. And it's a ranch. You don't want to weigh those things. All right. Then the metric you want to use is you want to compare price per square foot. So what's the sold price per square foot of these comps, and what's the range of those? Okay. Um, and again, you want to use properties that are fixed up. So if your property is distressed or a hoarder house or whatever, you're not going to use comps for hoarder houses or distressed properties. You want the best properties on the market to do your analysis. All right. And then what I do, I mean, everybody analyzes things a little bit differently. But when I'm doing my first pass, I compare the price per square foot. So I will take my top three comps, okay, and I will look at the sold price per square foot. And, what's the range? Ideally, it's relatively close. But whatever it is, it is. And so I start my evaluation based on the average price per square foot of the three comps. Okay. So that's again how I do it. I do the average. And that's doing the average I consider it kind of being on the conservative side. Okay. I'm aware of the lower end price per square foot. Okay. Because that's, it's not the worst case scenario, but it's not the ideal case scenario. Because if the appraiser comes back and says, no, the price per square foot is closer to the lower end of the one you found, well, that's, you have a discussion with them about it. And then the same thing on the other end, the higher price per square foot, the seller's going to say, look, that's, my house is worth that because that's the highest number and that's what I want, which is that's a natural reaction of sellers who don't sell property. But if I'm an investor and I'm doing an analysis and I'm computing the ARV, I'm going to go a little bit, I'm going to go right down the middle on that, which is on the conservative side. But I'm aware of either side, of either extreme, and what the arguments are going to be for and against either one. Ideally, if you're in the middle, you don't have too many arguments. But that's part of the fun of the negotiation. Okay. And then you're going to want to look at active listings. So here's another thing that novice investors do is they look at active listings and they say, well, this one is on the market for this price. Therefore, the ARV of mine is that price. Well, no, because anybody can put anything out there at any price. And it's like, it's like the ones we looked at yesterday. And this is where you look at actives just for the knowledge, and hopefully they'll get what they're asking for. And you never know, you can't say they won't get it, because there might be a buyer out there willing to overpay. Okay, so you want to have the active listings out there for knowledge. And again, when you're talking to a seller or your agent's talking to a seller, the seller's going to say, well, that one across the street is on the market for, $600,000. So mine is worth 600,000. You have to be able to create a cogent argument as to, well, just because it's on the market at that price doesn't mean that that's what it's worth. So you want to do that. All right. Now let's get into the four formulas. Hopefully I'm not going to go too far over, but wholesaling is number one. All right. And these line items that are in yellow do not apply to a wholesale deal, but I put them on here because they're going to apply to some of the other exit strategies. So you're going to know. These are going to be on the cheat sheet. So I'm not going to go into a huge detail about it. But when you're wholesaling, the essence of it, in a nutshell, is you're not wholesaling it to a retail buyer. You're wholesaling it to another investor who's going to do something with it and add value and make a profit. Okay. So you're a middleman. Okay. And so you have the seller, you have an investor, and you have an end buyer. So you see how, it just works the same way any supply chain works, but between the seller and the end buyer, there are two parties that need to get paid, okay? And that's you, the wholesaler, and that's the investor. So that's why, so the multiply by 0.70 in theory, that's the investor's profit, okay? So you're the wholesaler. So you're gonna do the ARV, multiply it by 70, compute the soft costs, closing costs, whether you're going to use a realtor or not, title company fees, etc. Some wholesalers don't estimate rehab costs. Others do. If you're a wholesaler, you do. You decide what you want to do. Do you want to estimate the rehab costs? Because ideally you've had eyes on the property and the investor has not had eyes on the property. Or do you say, no, I'm going to let the investor figure out his own rehab costs? All right. And then there are some investors out there that'll say, well, I'm just going to plug in a number, $20 a foot or $25 a foot. So if it's 1,000 square foot house, I'm just going to plug in 25,000 rehab costs before I see it to decide whether or not they want to take the next step. All right. Fast forward. You've got your assignment fee. You're the wholesaler. So it can be $1, it can be $5, it can be $5,000, it can be $50,000, whatever, because that's the wild, wild west. Then when you get there at the end of the line, you can say, all right, when I've got all this computed, now I know what my MAO, my maximum allowable offer, is going to be. And, I use, the MAO is the bottom line. That's where either the buyer or the seller finally draws the line in the sand, and one party or the other is going to walk away if that number is not achieved. So hopefully that makes sense to you. Um, Flipping, again, you don't have the multiple, okay? You don't have the investor's fee, um, because again, you're the investor is figuring out his or her profit margin, but you have the ARV, you have the soft costs, rehab costs, there's holding costs in flipping, which a lot of novice investors don't think about, that from the time you sign the contract to buy and you get the keys, it's your house. You owe taxes, you owe insurance, you owe maintenance, and you own utilities, you owe those four costs every day of the week until you sign the contract selling the property. So, like we heard, Natalie and Matt yesterday, they go, we're on day 92 of this rehab, and they're so sharp that they know what their holding costs are down to the day. They know what their taxes, insurance, maintenance, and utilities are. Oh, we're on day 92. That means I'm out of pocket, another $127 or whatever that number is. But there are holding costs, which are obviously for the time you hold the property. Cost of money, a conventional lender, until you have built a track record, you're going to be using private money or hard money to do flips, unless it's your own cash. Um, Taxes. This is, a question for your CPA that a lot of investors don't take into account, that the profit you make on a flip is usually considered ordinary income, but I'm not going to go anywhere past that without telling you to talk to your CPA. Then you've got your minimum bid, your maximum bid, and that's your negotiating room, which we talk about that more in the negotiating class a couple of weeks from now. All right, we'll dig down into that. Here's the BRRRR strategy and the house hack. Okay, so still you've got the ARV you've got to figure out, because that's what you're gonna get on the refinance, enabling you to repeat the last two R's. All right. Still have rehab costs. You still have holding costs, again, from the time you buy it until the time you get a tenant in there. Now, typically that's going to be 6 months, okay, because that's also what's called seasoning, which means that the lenders won't lend to you until you've got a tenant in there for 6 months. Okay. They won't refinance it. So you're going to have the holding costs until the holding costs are completely out of pocket for you until a tenant gets in there and starts paying you rent. Then you have another 6 months, okay, where you're getting income to offset your holding costs, but it's still not making you a profit, and you still don't have the cash flow yet, if you follow that. Cost of money, fudge factor, deferred maintenance, because now you're buying a house that you're going to keep for a long term. Okay, that means that you're going to have knowledge of, you know, age of the roof, age of the furnace, age of the HVAC, age of the plumbing, age of the electrical, age of the appliances, and the lifespans for all of those corresponding elements. Okay. Um, I'm getting a dishwasher in my house today. I've owned the house 20 years. This is my third dishwasher in 20 years. So that's about every 7 years, the dishwasher counts out, planned obsolescence. So when we talk about rehab, I have a chart with all those, lifespan things of all of these typical elements. But you're going to want to have, you can call it a fudge factor, deferred maintenance, CapEx. It's the same name, but for, same name and same reason, just different names. Vacancy factor, which a lot of investors don't include in, but lenders do, and appraisers often do, um, especially in multi-unit properties. So whether or not the property has ever had a history of vacancies, these lenders or appraisers are going to plug in a number, which might be 3% or 5% or whatever it might be, because it's not uniform. Um, then you have your cash flow number uh, after the refi. So after you've fixed it up, after you've got a tenant in there, and now you're going to, do a, it's called a cash out refi, which is the third, it's the third R, the refinance. All right. Your lender's going to give you the money for a mortgage and some cash because you built some equity in it, and and money to pay off the private lender who you borrowed from to do the fixing up of, to do the buying and the fixing up. So the refinance, you repay your lender, you pay off, whatever a rehab cost was. If the private lender didn't do those, you pay those off. And ideally, you've got a tenant in there that after your expenses, um, covers your mortgage and some, and then some. Okay, and that's your cash flow after the refi. Now it might be $50, it might be $100, it might be $500. That's part of your analysis, and part of your decision is what is your tolerance level, what's your long-term goals, as far as, you know how much do you need in cash flow for it to be a worthwhile deal for you to go through. All right. Turnkey is just the same without rehab costs. Okay, but we're gonna call it deferred maintenance. Okay, but a turnkey, turnkey means there's a tenant in there with a lease theoretically, which means that it doesn't need repair to be rented out. Now, it might need, well, like these ones I've talked about, it can use repair in order to get more rent, okay? But that's a different conversation and a different analysis. But so this is just for turnkey. You're exchanging money, and you're taking a property that's fully rented, has a certificate of occupancy, has tenants in there with signed leases. These are the numbers that you're gonna want to know, and these um, this is where you can. I'll talk a little bit more about it next week. You can get what's called a DSCR loan, which is a debt service coverage ratio loan, which means if you're buying a property that, unlike the Burr, where it didn't have tenants before, you're getting a new tenant. These, you have tenants that have been paying, so it has a track record, and it's less risk for the lender. All right, so the lender will say, well, okay, Joseph, I'll give you the loan based on the income that you're getting from the tenants that you're inheriting. Okay, that's a DSCR loan, and this is where you have to, massage the numbers and analyze the numbers again to determine if it's a good deal for you based on your short-term goals and your long-term goals. Okay. So I know I did a fire hose today. Um, but I'll put the cheat sheet in the chat in a minute, and if you don't have access to that, um, or you can't open it or whatnot, give me your email and I'll email it to you. But here's the review: top of mind all the time: taxes, insurance, maintenance, utilities, cost of money, transaction costs, and Uncle Sam. Just kind of beat the drum and get those numbers into your DNA. And again, the more analysis you do, the more comfortable you are at estimating accurate numbers. Because that's the other thing about this business is you cannot, especially you're buying distressed properties, which most investors are trying to do anyway, that the current owner does not keep accurate records or does not share them. So you're really going to have to kind of fly blind until you get comfortable doing it. And you'll only get comfortable by, like anything, by continuing to do it, by doing deals, and then you build your own track record where, again, the more you do it, the more comfortable you get estimating these numbers. All right, coming events. Next Friday, I've dropped the Tuesday ones kind of due to I'll say due to my scheduling. It conflicts more than I thought it was going to. So I've dropped those Tuesday Zooms for the time being. So our next one will be next Friday. I'll talk about money. February 6th, Rainmakers with Hunter, who's going to he doesn't know it, but he's going to be kind of our guest speaker. And that's it. So yeah, just a reminder to work on the fundamentals. Don't get too overwhelmed. Don't, listen to podcasts, but don't listen to too many. Don't watch too many YouTube videos. Don't read too many books. Just try and focus on the fundamentals and practice and, you know, analyze a deal a day. Put it, I find that, if you're going to change any behavior or learn anything, you have to change your habits and you have to, exchange a bad habit for a good habit. And it's really been powerful for me if you just discipline yourself to do one a day is not overwhelming. And you just say, I'm gonna do the Hurley. I'm gonna analyze, I'm gonna set aside 1 hour a day, whatever hour it is, and it's non-negotiable, where I am going to focus on practicing how to analyze deals. I didn't even talk today about A pods and multi-unit properties and things like that because it's overwhelming enough. I'll talk about that in the multi-unit session, fundamental session. But anyway, that's that. Just by way of reminder, these are the fundamentals that I teach. That this is my list based on my 21 years of experience working with investors. That these are the topics that are most talked about and done every on a regular basis, if not a daily basis. So I think it's a pretty solid list of topics for you to familiarize yourself with when you want to learn the fundamentals. There's tons of resources out there. My little classes are not the only ones, but this is the type of stuff that you need to know. All right. About the A2REIC, learning, networking, deal making. I think we had a couple of deals bubbling up that happened at the table yesterday, which is kind of mind blowing. But that's it. I mentioned last week, for those of you who are on, and if you have not done so already, um, and you're going to be regular and involved and engaged, and you find value. I appreciate you contributing to the cause, as they say. Um, Commit to learning, create a plan, long term, short term, analyze a deal a day. Come back next week. All right, 2200 Washtenaw. I'm just going to ask if you have questions about it. So 2200 Washtenaw this is a duplex that is not on the market. It is currently generating just shy of $3,000 a month in rent. Well, even though the one is vacant, but when it's rented, it's $3,000 a month in rent. It does have a substantial amount of deferred maintenance. That's why one of the reasons things are hesitating. You can't see it in this picture, but there's a huge tree on this side of the property that the roots are pushing against the foundation, that something's got to be done, ideally sooner rather than later. But anyway, um, that's it. I'm not going to run through the numbers with you because just told you where to get your own numbers. Um, but this would be, again, it's not a burr. It doesn't need to. It needs to be fixed up a little bit to rent, but not such a rehab that's going to qualify it as a burr, where you increase where you buy it short term and do it that way. This is not. It's kind of a hybrid burr turnkey situation. Um, but anyway, all right. We can talk more about that at another time. The end.